Good day, traders. We're in our live trading room and we had a question and we felt it would be a good idea to make a video of it because this question comes up quite often. How can you forecast support or resistance using volatility, prior swing movement, and our proprietary indicator called the swing magnitude factor? It's not a secret. We teach it in every class, so everybody knows it. It's really not that complicated. It's based on prior movement. There's a reasonable expectation for the market to move up or down. So let's get to it. In the morning, we publish this for you. If you look at today's report before the market opened, 8:45 a.m., that's Eastern time. Do you see this swing magnitude? 191. Based on prior price movement and volatility, that is a reasonable expectation for the market in general to move up so many points, and you would expect it to get tired or meet resistance, and then sellers would take over. And if you've traded at any length of time, you'll notice that during a trading day, the market will have up moves and down moves. Simply, traders go long, they have a profit, they're going to sell. Some sell small, some wait for a big home run, but inevitably the market turns back and goes in the other direction. If you could accurately forecast those swings, think of the advantage you'd have instead of trying to chase every little wiggle. Okay, so today it's 191. Well, we had the Fed report. So, how are we going to forecast how high the market might go or low when the Fed report comes out? And the reason there is there's usually a volatile price move that's overdone. It's a bunch of stops getting hit. The market manipulates it. The big traders know about this. They fade those big moves. Well, how do you know what the big move is? Okay, 191. Let's think about this. Here it's about 5 or 10 minutes before the report. We see previously that the market went down. So, what do we look for? Well, a reasonable time look back period. We don't want to go to 2 o'clock in the morning, but this was 1:30 Eastern time, and we're looking at the high and low prices. So very quickly, we get a data box so we could tell what price it is, and here we are. And if you, I don't know if you could see it through the video, the low of that price move down was 42,594. That's the low part of the swing since we're over here. We want to see how high would it go before reversing. That's our challenge. So we draw some lines here. First of all, our low, all right? And we're saying if the market has a fast run up from the low that we've seen going back, about within an hour, if it has a run up from there, 42,594, and goes up 191 points, it'll go up to 42,786 before meeting resistance. That means anyone who's bought it down there would be happy taking a 191 point profit. Again, this is what the market was and has been doing. All right, what about the opposite way? Currently trading when we identify this, where the high was 42,716. Wouldn't it be possible to come down 191 points from there right after the Fed news, which would cause sell stops to be hit until the market was exhausted and traders who were short make money and buy in order to cover the short trades that they have, and some bargain hunters will come in to go long. What has the market been happy with before? 191 points, roughly. So we put in a line at 42,525. Here's the cool thing. You can do what a lot of professionals do. On a big move, you fade it because the initial stop run will cause the market to exhaust pretty quickly and it tries to return toward the middle. Same way if it goes down. And that's what we did. I just want to show you how we measure it. We literally take the current price and look at a recent high and a recent low and do our calculating off of that. What's reasonable? Well, let's face it, we're day trading. You don't have to look back last July. You can look back in the past 30, 45 minutes. This is the high, that's the low. You don't need to go back noon, 9:30, the open. And so let's see what happened. We had sell limits to short, buy limits to go long, not knowing which way the market's going to move. Well, here comes 2 o'clock. It pulled back a little bit. Look at that. Isn't that amazing? If you think about it, we quickly got a move up, faded it short, and literally within 1 minute had over 100-point profit. And then the market goes sideways trying to regather itself before it ultimately goes back, and then it creates a double top. So you could short it again if you wanted, because anyone who's shorted before made a lot of money. And guess what? It goes then back to the opposite side of our 525. You could have kept your buy order there, although we did cancel it and put it back in later to cover a short. So in this case, we went short because it was overdone on the upside, got our profit. That was sort of an indicator that maybe the market had topped out. And then when we took short trades, when the trend turned down, well, we had a nice target of 525, especially when it broke the previous support. If there are any other questions on how we trade, this is how we don't get trapped with stops and bad fills. Let the other guy do it. So you can like us, come into our trading room, subscribe. We'll make more videos like this. But better yet, watch us trade, trade with us, learn the methods, and start making some money instead of continually losing money. Thank you.